Hello, I'm Hilton Super, the Vice Chairman of the Studium Group, and today I have the pleasure of speaking to Jannah Patchay, who is the Executive Director of Digital Foundation. Now, this is where we interview people who are changing the world, people who are inspiring us with their achievements, their creativity, their acumen, particularly with the use of technology. Now, in previous interviews, we've interviewed over 300 amazing people and got at least 16 million views on YouTube. This interview series on Cities ABC is in partnership with our platform openbusinesscouncil.org, a Web3-based platform utilizing technologies that employ the use of truth and trust through the unique corporate digital identity using blockchain and the deployment of data analytics, AI, and machine learning in its smart marketplace. So today I'd like to introduce you all to Jannah Patchay, Executive Director of the Digital Foundation. So Jannah, tell me, where are you?
Where am I in the world?
Yes.
I'm in London, in sunny, windy, cold London, which is about to become very dark London in the next hour or so.
Thank you. In terms of what you've done, you're a fintech expert in terms of the blockchain, you're an influencer, you've done a lot of policy advisory work and a consultant. You also write a lot. And you've got 2 decades of experience in financial markets innovations in terms of digital assets, sustainable finance, policy, regulation, and market structure. So a lot on your plate, but tell us a little about your journey, how you got here. Obviously you were educated at Cape Town University, so tell us a little bit about that.
Sure. So my undergrad degree was actually in computer science and maths, the University of Cape Town. I'm South African originally and grew up in South Africa and came to London in January 2000, actually, during the dot-com boom. So my first job was actually, well, my first permanent proper job, that is, was for a dot-com in 2000 as a software developer, which was a lot of fun. And of course it went bust. So very early on in my life, having worked for a dot-com that went bust in, within 18 to 24 months of me joining it, I developed a healthy distrust of permanent employment and a kind of, I think, more of an independent approach to the kind of work that I wanted to do and things like that. So from then I did a little bit more on the development and technical side for a few more years. I moved into consulting and financial services, so worked for a few boutique consultancies around the City of London. During that time, I moved more into the business analysis, business consulting side of things. And I worked across a huge range of different areas in financial markets. I did a lot in prime brokerage, which is hugely wide-ranging in itself. And also developed an interest in and a strangely obscure expertise in setting up new trading venues, which is not just about the technology of putting together a new trading venue, but also how do you build new markets, how do you build liquidity in new products and services, and how do you bring participants together and things like that. So it's a really interesting space. And over time, so a couple of things happened. First of all, I got tired of working for other consultancies and being told what to do. So I went up on my own and never really looked back. And secondly, a lot of the areas in which I was interested became more regulated. This was kind of post-financial crisis, 2009, 2010, and the G20 commitments to bringing as many OTC derivatives into more of an exchange traded and centrally cleared environment were kicking in. So that manifested in Dodd-Frank and MiFID II. And so if you were working in the space that I was in at the time, you necessarily had to develop a lot of regulatory expertise, which turned out to be something I really enjoyed. And that eventually led to me doing an LLM in international banking and finance law. During that time, I was doing that part-time, and I was also doing a lot of work for banks and small startups, more for the banks on big regulations like MiFID II and Dodd-Frank and what they had to change from a business perspective, and more for the startups actually on kind of their path to regulatory authorization and regulatory strategy and what they needed to change about their business models and operations in order to achieve regulatory authorization and things like that. So my LLM specialized in cross-border and extraterritorial issues in OTC derivatives markets, which was at the time fairly obscure, but then coincidentally Brexit happened. And suddenly this obscure academic topic was a reality. And that led to a couple of years of doing some very interesting but incredibly depressing work on Brexit strategy and Brexit risk management for various types of financial institutions. So it was in 2018 that I was looking around for what the next thing was. And a friend recommended the Oxford Blockchain Strategy Program. So I did that and developed an interest over the next couple of years, very much in applications of distributed ledger technology and blockchain to traditional financial markets. So less on the crypto side, more on how can this be, a transformational underpinning technology in the digitization of financial markets. And also, what opportunities does it create? Because there are some super interesting opportunities and applications of, smart contract governed derivatives and bonds and things like that to enable a transition to sustainable finance and incorporate better kind of data management and reporting and things like that as well. But as I spoke to more and more people in this space, it became clear that the missing link in a lot of the experiments at the time, whether they were, DLT-based bond issuances or things like that, was a counterparty risk-free settlement leg. Because if you're to, financial institutions, to banks, say, or even just you and me trading a digital bond or a tokenized bond, for example, we don't want to settle that in Bitcoin. We want to settle it on Ledger so that we realize the efficiencies of instantaneous settlement and, that instantaneous exchange. But we have to find something that's on the Ledger to settle in. So what options have we got? We've got one of the cryptocurrencies. So we could look at Bitcoin or ETH, but those are quite volatile, and we don't want to be, trying to manage currency risk at the same time as we're dealing with that settlement. So a lot of firms were limited by that. There were stablecoins. So stablecoins are effectively tokenized forms of fiat currency, the most famous being like Tether and USDT or Circle's USDC, which are used extensively in cryptocurrency markets and for intermediate holding and settlement and things like that. But the problem with most of those big stablecoins is they're not regulated at the moment. And they also expose counterparties to issuer risk. And we've seen in the past year or so, both USDC and USDT have lost their peg to the underlying currency, and that's created volatility and uncertainty as well. So no financial institution wants to expose themselves to that. So that was how I got interested in central bank digital currency, central bank issued digital native forms of currency, and their potential to solve these settlement problems, their potential to make payments more efficient, and to basically underpin the transition to a digital economy. Yeah. And so that was my journey to CBDC and all the different kind of privately issued flavors of digital money as well.
Wow. You've given us such a great oversight to what you've done, and you've got such a lot of experience in working from the regulatory side and actually implementing a lot of these things to date. And the key thing here is you're now into, I think, the pinnacle of digital currencies, being central bank digital currencies. Everybody's talking about few countries are starting to actually implement it. There's various pros and cons. You mentioned one of them being efficiency and cost reduction. But before we go into that, can you just describe to our viewers what is first of all, a digital currency, particularly a central bank digital currency?
That is a really good question, Hilton, because I think for most people, they hear this talk of digital currencies and they think to themselves, but hang on, most of my transactions day to day are no longer cash-based. If I'm transferring money to another person or to a business, I'm either making a card payment or I'm doing an account to account, and that's digital, isn't it? But I think the thing to bear in mind is that all of those systems have evolved over decades, in some cases centuries, And while we don't have wheelbarrows full of cash being exchanged at the end of the day between banks anymore, many of the processes and underlying assumptions that underpin the systems and processes behind how we make payments and exchange money today are based on the assumption that wheelbarrows full of cash may be exchanged at the end of the day. So we have artificial latencies and we have artificial inefficiencies that are built into the system that don't need to be there. And so when we talk about digital currencies, what we're talking about is digital native forms of money. And it's basically the opportunity to take the requirements that we have today and in the future in terms of what we want to be able to do with money, how we want to be able to make payments in, both the real world and in future in the metaverse as well. And what can we do in terms of delivering those requirements with the technology that we have today? And to if we think about it, we've now got at our disposal, we've got DLT, we've got AI and machine learning, we've got the cloud and big data, we've got all of this stuff that didn't exist, and we have the opportunity to design something new from the ground up that's more scalable and fit for purpose and extensible as well into the future. And that is what we mean by digital currency.
I got it. So, I mean, if you look at the basic principles of any digital currency, there's a central bank. Any currency, there's a central bank. And then you've got around the bank, you've got all the banking and financial institutions that participate in the way that value transfer is done, and then feeding that into the economy and blah, blah, blah. When you have what I call a digital currency, the first thought I have in my mind is you taking something that is a decentralized model in the traditional world, and now you disintermediating and decentralizing it. So how does that fit with the central bank?
So again, a really good question. And I think we have to distinguish between the technology that's being used and between the kind of market structure and model that's put in place. Mm-hmm. So it's important to bear in mind that, first of all, from a technology perspective, not all central banks are considering using DLT or blockchain. Many are, but it's not a prerequisite. And in fact, China's, which is the most famous and the closest to being live right now on a large scale, does not. And of course, there are benefits of using DLT, and but it's not necessary. And I think a lot of the reason people kind of conflate DLT and CBDC is because there's a very clear path from the introduction of cryptocurrencies to, stablecoins, to what was then Facebook's proposal around then Libra, to central bank digital currency. But the underlying technology is, in theory, irrelevant. So you could have a very centralized model, or similarly, you could have a model that reflects more like the market participant structure. So if you've got a central bank issuing the digital currency, and you've then got banks and kind of payment providers and an ecosystem around that operating nodes on a blockchain, then that could be another model. But as I said, there's a distinction between the technology and then the market structure as well. And in most cases, for a central bank, most central banks don't want to move to a model where they're providing services directly to the public. Right now, central banks are, fairly closed shops. They deal with very sophisticated financial institutions that have access to central bank accounts and reserves and things like that. They don't want to have to hire thousands of people and put them into call centers to do account opening and account management. So one of the big kind of popular fallacies is that everyone will have accounts at the central bank, and that's not true. I don't think there's a central bank in the world that's proposed that. They all propose various kind of flavors of model in which they issue the currency, and then there's this ecosystem of participants or payment interface providers that basically distributes it and does all the kind of accounts opening and wallet creation and support services and things like that.
It's very interesting, because if you look at that type of structure where you're now building you're building into the existing ecosystem effectively, where the banks and other financial institutions are dealing directly with their customers. But one of the things I'm now thinking about, who bears the costs of this? Because if you let's take a digital pound as example, we'll get onto that in a second. A digital pound will always be a digital pound. Every time it's exchanged along some sort of distributed supply chain, the participants need to be able to take some value out of it to justify the business model that they have in that value chain. How does that get managed? Or should we talk about that later?
No, that is actually a really, again, a very interesting and topical question, and one around which there's a lot of discussion at the moment. Because also, you know, the Digital Pound Foundation, which we'll get onto, alongside many other, you know, both public sector and private sector actors and many other similar associations globally, we don't see there just being, you know, central bank issued digital currency in the future. Just as today, we have both publicly issued money in the form of central bank reserves, which only banks have access to, and cash, which all of us in theory have access to, provided we can actually find an ATM and somebody who will accept the cash. But so we have that kind of publicly issued money, which represents direct claim on the central bank. And then, but we also mostly use privately issued money, and that privately issued money is our deposits that we hold at commercial banks. Because most people don't really realize that when you know, take your $100 or £100 that you had stashed under your mattress or wherever to a bank branch, should you be able to find one in this day and age, and you deposit it in a bank account, it's no longer your £100 or $100 anymore. What you have is a claim against a commercial bank for £100 or $100, but that doesn't exist anymore in the same form. It's now just a claim that's backed by maybe, you know, 10% of that in terms of actual funds held, and it then is also backed by loans the bank makes, various, you know, liquid assets and things like that, a lot of prudential regulation, a lot of kind of trust and faith in the system and the financial services or compensation scheme or deposit guarantee scheme, whatever you call it in different jurisdictions. And that's the basis of the fractional reserve banking system. And so in the future, we expect to see that there will still be the split between publicly issued and privately issued money. So CBDC will coexist with stablecoins, which are already out there, but regulated stablecoins in the future. It'll coexist with potentially bank-issued tokenized deposits or tokenized commercial bank money, which are becoming more of a hot topic lately, tokenized e-money and things like that, as well as existing forms of money. So we don't expect to see cash go away, and it will linger on as long as there's demand for it, and all the existing payments infrastructure that we have right now as well. So it's very much going to be that kind of ecosystem in the future. And so the big questions are going to be what kind of policy and legal and regulatory framework do jurisdictions need in order to make sure that that kind of ecosystem is diverse and effective and competitive and provides the right kind of economic and social outcomes rather than just leading to walled gardens.
So I just want to unpack what you've talked about. So you mentioned two things. You've got the central bank digital currency, which essentially is issued backed on the reserve mechanisms of the central bank, and then distributed as money in money flow transactions with the other participants, the other banks and other financial intermediaries, et cetera, so that one CBDC, one unit of that will always equal the same unit in, you know, pari passu with everything. So it's based on the reserves of the central bank, in principle, bank digital currency. And then you've got stable coins, which are issued potentially by not the central bank, but by authorized third-party regulated entities who effectively issue, say, a digital version of that currency, but they ensure that they buy certain securities so that it ranks pari passu 1-to-1 with the value of those assets. Is that a good way to unpack this?
Yeah, and then you could also have tokenized deposits as well, where individual banks, because stablecoins are typically like non-bank issuers, where banks take those liabilities sitting on their balance sheets and they tokenize those, and you use those as a means of payment as well. And the concept to which you're referring, that a pound is a pound is a pound, or a dollar is a dollar is a dollar, is one that's increasingly policymakers and regulators' agenda at the moment, and it's generally referred to as the concept of the singleness of money or uniformity of money, that £1 or in your bank account is to all intents and purposes the same as a pound coin that you hold in your wallet, is the same as a pound in a stable coin that you might hold in the future. And so the big question is, how do you ensure the singleness of that money? And today it's preserved through the regulatory infrastructure that we have, and basically through your ability as an individual to convert freely and at par between those different forms of money. So you have your probably most of your money in a bank account. You can go to a cash machine though, and you can withdraw that into cash, which is so you changed from a claim against a commercial bank into a claim against the central bank at par and on demand, which has preserved that singleness of those different forms of money. And in the future, that's probably the role that CBDC will increasingly play in this ecosystem. The fact that the ability to convert seamlessly and par between different new forms of digital money and CBDC is going to be what preserves that singleness of money in an ecosystem of digital currencies.
Got it. I understand. So all the work that you've been doing now with the Digital Pound Foundation, what was the inspiration for this, and what is your ultimate goal and vision?
So the Digital Pound Foundation was actually inspired by the Digital Dollar Project in the US. And I think the Digital Euro Association in the EU had about a 15 or 18-month lead time on us as well. But there were these projects and associations setting up in different jurisdictions that were kind of combining the usual work of trade associations with also some aspects of think tanks in looking ahead to what this future ecosystem of digital money was going to look like and what it would require and things like that. And really bringing together the whole ecosystem of different players in this space, both from like the traditional financial services perspective, but also from the crypto native landscape and things like that. So basically convening everyone to have a discussion about what this will all look like in the future. And so we kind of started off discussion started off in about 2020. We were born out of the Whitechapel think tank, which was a group in London that had been sort of meeting for many years, probably since about 2014, to discuss developments in DLT and their application to financial markets. And so the originating team members of the Digital Foundation were basically all members of the Whitechapel think tank's Future of Payments working group. And originally, like the Digital Dollar Project, we were planning on focusing on CBDC. But in our early discussions with the Bank of England about what we were planning to do, they said that they saw the UK as being a spectrum of publicly and privately issued digital currency, and that the big policy question was where on that spectrum does the UK want to be, but there was not going to be like any kind of dichotomy between the two. So we decided that we would cover the whole spectrum and launched in October 2021 with our initial cohort of members. And since then, I've kind of taken it from there. We've got a number of working groups at the moment. So We've got a policy, legal and regulatory working group, which pretty much does what it says on the tin. And I lead on the policy engagement side of things. We've got a use case working group that's looking at practical applications and use cases for mainly CBDC, but digital currency in general. We've got a payments working group, which is looking at the kind of wider payments ecosystem and stuff like that. And we've got an identity and privacy working group as well, which is looking at the requirements for digital identity and considerations around privacy, because that is a huge area of public interest at the moment. So in terms of what we do a lot of policy engagement in terms of both meeting with regulators and policymakers, as well as responding to consultations and discussions and things like that. We work with other trade associations and industry participants to develop policy positions and to explore various topics. We have lots of roundtables, both public and private, to explore, do deep dives into different topics. And we do a lot of public education as well, because both to the general public, but also to the financial services sector, because even within most financial institutions, people aren't really necessarily aware of these concepts. So we do lots of podcasts and publications and things like that as well.
So in your work that you're doing, and what I'm hearing what you're saying is when you've spoke to all the different stakeholders within the financial markets, from the central bank to all the banks and participants, etc., that there's not going to just be one CBDC. The spectrum that you talked about allows for other participants to bring stable coins or other instruments to let's talk about the pound ecosystem. Is that a correct summary of what you see?
Yeah. So we'd more often refer to it as an ecosystem of both public and privately issued new forms of digital money or digital currency, with the publicly issued digital currency being CBDC, and then the privately issued forms being everything else. So all the different flavors we've talked about so far.
Okay. So essentially, we're not talking about cryptocurrencies. We're talking about specifically designed digital currencies that are for the transfer of value, where the base is the value of £1.
Yes. So when we talk about digital currency, what distinguishes it from cryptocurrency is that we're talking about digital native forms of government issued or central bank issued fiat currency. Yeah.
So what the takeaway from this would be that if I am working with an institution that is building a stable coin, and the stable coin is just backed by gilts, for example, I mean, just that could potentially be a participant in this future ecosystem within the UK regulatory framework.
It could potentially. So the future UK regulatory framework for stable coins is still under discussion, and the extent to which stable coins in the UK can be backed by high quality liquid assets as opposed to just cash reserves held in a bank account or something like that. But in the same way that stablecoins are at the moment, or in fact that e-money in the UK can actually be backed by non-cash, like a very limited range of non-cash short-term liquid assets, we would anticipate that stablecoins should be as well. There are some distinctions between systemically important stablecoins in the UK proposals at the moment and just normal stablecoins. And there were a couple of discussion papers published on this by the Bank of England, looking at the systemically important stablecoins, and the FCA looking at kind of all stablecoins, which the industry is still processing. And those responses are due on the 6th of February, I think. So a lot of it is still under discussion, but we would expect that for the majority of the stable coins, they can be backed by other types of assets as well.
This is very interesting, because if you look at the financial institutions in sort of the banking world, they have an asset base of various liquid assets, which allows them to have a certain capacity to do a number of transactions. And the gap between the value of those assets and the amount of money that they participate in and add to the ecosystem is done through some form of leverage, because there's a they are participating at a higher value than their actual reserves that they have. And then you've got the concept of a stable coin, which tends to be assets that are, say, 1-to-1, that they're unleveraged assets.
Yeah, even though it's not necessarily 1-to-1 cash backed, it's fully backed in terms of the reserves held. Yeah, I think what you're kind of referring to there is the main distinction between banks and what tokenized deposits would represent and stable coins. And in previous consultations, the Bank of England and in the UK and the ECB in the EU are doing a lot of work on understanding the impact of the introduction of stablecoins on banks' ability to create credit. Because in the UK and the EU, banks are referred to as credit institutions from a regulatory perspective. And this really describes their most important function. So the mere fact that you hold deposits doesn't make you a bank necessarily, or the mere fact that you lend actually doesn't make you a bank. In fact, aside from like limited amounts of consumer credit in the UK, what most people do not realize is lending is actually an unregulated activity. But it's that it's the fact that you are an institution that both takes deposits and then uses them as the basis of fractional reserve holdings in which you extend credit by making loans, which are basically creating deposits or creating money out of thin air, as some people refer to it, that makes you a credit institution. And so the deposits that you hold basically determine how much credit you can create. And most modern economies are predicated on credit creation as a primary driver of growth. So if you introduce a CBDC or you introduce stablecoins that are fully backed, there's a risk that people will think, well, why would I want to be exposed to the risk of holding my money in a bank where I could have a bank run and, I'm only capped up to the, financial services compensation scheme limit. Why wouldn't I just hold them in these like fully secure forms of money? And so that is where a lot of kind of regulatory work is aimed at, looking at introducing like safeguards and limits and things like that to limit, at least initially, the outflows from banks to either CBDC or stablecoins, so that the impact on credit creation is limited as well. And if you know about the concept of narrow banking, in a sense, a stablecoin issuer could be thought of as a narrow bank. Basically, it's the type of money that it provides is fully backed by reserves. It's not engaged in any of that lending. It's not engaged in any of that credit institution. So economically, those are really different functions.
But the real challenge for a central bank, if you look at the financial system as we know it today, when you start introducing the shadow banking, the stable coins, etc., there is an impact on what are called financial stability on the central bank and its ability to manage, as we call, the money supply, M1, M2, M3.
Yeah, that's true. And the Bank of England has said on a few occasions that its role is not to protect the business models of commercial banks as they apply today, but rather to preserve financial stability. And preserving financial stability in this context means preserving the ability of some institutions to create credit, but not necessarily protecting or gatekeeping existing business models. So I think there's this kind of consideration of a balance between the need for innovation and the potential innovation that can be offered by stablecoins and the technology on which they're built and things like that, versus those kind of broader financial stability and monetary policy type considerations as well.
In terms of privacy concerns, I mean, one of the great things that you and I know is that the minute you start using some form of a digital currency or any digital payment, the individual needs to prove who they are. So that you've got this digital identity concept coming in. which at the end of the day, anybody participating in the digital currency payment system is a known actor, an identified known actor, and their transactions are effectively transparent because of the way that they are recorded, which should be a big tick. Oh, hurrah! Now we know who's spending the money, where they're spending it, and how much they are spending, and when they spent it. But there's been a lot of pushback from financial institutions for the use of digital money. How are we going to find a way in which those two extremes are come together?
I think a lot of the pushback has been less on cryptocurrency or that aspect of digital. It's been more around, so when we hear in the news about financial institutions like banking, crypto firms and things like that, it's more to do with the number of scams that are out there and the fact that ultimately banks are ending up being liable for a lot of the account holders who've been scammed out of account holdings and things. So there's a lot of other drivers for that. I think most banks, when it comes to what they're thinking about around digital currencies or digital money, they're thinking about how will they fit into this ecosystem and how do they need to keep up with it and stuff like that. And they're not necessarily thinking of cryptocurrency as the driver for that or anything. They're thinking about what the future involves with CBDC and tokenized deposits and how are they going to compete with stablecoin issuers and that sort of thing. I think when it comes to privacy, it's the general public that is the most concerned with privacy. And a lot of this is down to, I think, fallacies that people have about the banking system and the way money works right now, and also about, what a future like CBDC design might look like as well, and a general distrust, I think, of governments. So I think if, what was then Facebook had introduced what was then Libra, 2.3 billion users wouldn't have hesitated to be using that to make all their, payments or remittances to friends and family members across, the Facebook and WhatsApp ecosystem and things like that. And that's a case in which they are essentially the product. It is all about the monetization of their personal data and their transaction data and things like that. Now, a central bank doesn't have the same incentive to monetize your data. From a financial crime prevention perspective, it's much more interested in broad patterns of behavior, but also it doesn't necessarily want to be the one who's, operating those systems. If it can devolve those out as far as possible, that's the ideal, which is why in the model that we have today, it's the commercial banks that are required to do KYC and AML and onboarding and ongoing transaction monitoring and financial crime monitoring and sanctions reporting and things like that. And most proposals, including the UK's proposals, reflect that. And personal data from those commercial banks can't be accessed by a government agency without due cause and without a search warrant, without going through, the whole legal system and the courts and things like that. And in future, the proposed model would ensure that it's the same. And similarly, the central bank won't collect personal data. That data will be captured at the level of the commercial banks. So I think there is a lot of detail in that, but there's also a lot of, people don't understand exactly how much is known about them at the moment in the current, financial ecosystem, or by, most of the private providers that they use as well, which is probably, to me, a lot scarier than, what a CBDC might introduce.
So in terms of the technology risks, obviously, you're building at the moment, the technology that we are currently using is based on legacy systems. Sometimes when I want to make a payment from one bank to another, it can take 3 to 5 days for that payment to go through. There's new institutions coming on board who will do instant payments across the board. When we start moving towards CBDCs, is the infrastructure going to be completely different and separate, or will it be integrated into the current infrastructure of all the participants in the financial markets?
I think by necessity, it will be different and separate, but I think we will need interoperability and interaction between the two, because we're first of all not going to go overnight from a system where we have, delayed settlements, where we have payment latencies and inefficiencies and things like that, to a magic one where we have, instantaneous settlements and payment happening. Legacy infrastructure will still exist and it will continue to run. New infrastructure will be introduced, but it's going to take years before, front to back processes and systems can be fully, re-architected and re-engineered and optimized to work with those. And so we're going to see a lot of this kind of intermediate landscape where some of it might be, we have, super efficient digital currency infrastructure over here, but sometimes we may need to actually introduce latency to get it to work with the older systems, and then gradually, move off that kind of bridge over time to a more, native infrastructure and stuff. And so that's something that we're seeing is increasingly under discussion about how that kind of transition is going to take place.
And in terms of the cross-border challenges, so for example, actually, funny enough, even in the UK, you've got a Scottish pound and an English pound, and they rank 1-to-1 on exchange rates to each other. And if I want to go and buy a euro with a digital currency, the on-ramps and off-ramps and exchange of that would use the existing mechanisms, or would I have to exchange a digital pound for a digital euro?
So lots of interesting things there. And I think that's where a lot of exploration is happening at the moment. So the BIS, the Bank for International Settlements, is doing a lot of projects in that space, looking at different ways in which this can be implemented. It's important to bear in mind, there is no interoperability between different currencies today. When you want to, convert from pounds to euros or pounds to dollars, it's often, it's behind the scenes. It is not straightforward. Often, various jurisdictions have constraints on who can access what, and, who can ultimately access central bank money. And so what's happening behind the scenes is this hugely inefficient network of, Swift messages cobbled together with correspondent banking. And we're South African.
Exactly. I know.
Yeah. So, 5 days later. But when it comes to a lot of the work that the BIS has been looking at in terms of the feasibility of cross-border settlements, payments and things, the main barrier is not technological. It's not difficult to design systems and to design mechanisms for actually having some kind of logical interoperability and technical interoperability between different national currencies. The main challenge is the governance on that level and the cooperation, the multilateral cooperation that's required in order to agree on some of those principles and standards and stuff like that, which is the same as the situation we have today. Technology is probably not the issue, but we don't have correspondent banking systems because of technology. We have them because of policy and legal and regulatory issues.
Now, one of the things in terms of my money, and that is that when there's, or anybody's money, when there is a crisis, people rush to the bank to get out cash or move the money and things like that, which in uncertain times creates what is called a potential for bank runs. What mechanisms are there in place to stabilize the system if you are now moving towards a digital currency?
So if a bank goes down today, there will be people who lose money. And again, this is due to the fractional reserve banking nature of the modern financial system. So when you deposit your money in a bank, again, you don't own that money anymore. You have a claim against the bank for it. And because a lot of lending has happened using that money as leverage, if everyone were to go to the bank and try to withdraw all their money at the same time because they all lost confidence in the bank at the same time, or they all lost confidence in the national currency or something like that, the bank wouldn't have enough to go around. So it would just freeze all withdrawals for everyone. No one would have any money, and this would be a terrible situation. And that's why we have, in the UK, the Financial Services Compensation Scheme or deposit guarantee schemes in other jurisdictions, where your money is protected by up to a certain level. So in the UK, I think it's like 70 or 80,000 pounds or 85,000 pounds per bank account. In the US, it's more at $250,000 per bank account. And how that's backed is all the banks are forced to pay into this insurance system that pays out in the back of this. Now, again, if you have CBDC and other new forms of digital money and things like that, there's an argument that is made that, well, this makes a bank run easier because people don't even have to go and queue at cash machines or at bank branches. They could just, transfer everything into CBDC or into a stable coin. And again, that's where central banks who are looking at regulation in this space are at least looking at initially introducing limits and holdings so that they can carefully manage outflows from traditional commercial banks and things like that, at least in the short to medium term.
So Jannah, looking ahead and the work that you're doing, which I think is admirable, and I can want to applaud you for that, because it's so nice to see in action and see the development from what I've been reading. And how far are we away from actually having, rather than, we have some forms of digital centralized or central bank digital currencies, but how far are we away from ones in UK, Europe, and how long would it be before we all embrace the use of it?
It's a really interesting question. Again, so China is obviously the jurisdiction that has while its CBDC is still in theory in pilots, once you've got a pilot of 500 million people or whatever it's up to right now, that's pretty much live, really. But I think in other jurisdictions like the UK and the EU, it's going to be a slower road to adoption. Most of them are saying they don't anticipate seeing an actual CBDC until, the second half of the decade. And I think that in some cases, especially for the retail usage of CBDC, that might slow down a little bit as well, primarily because of two things. First of all, for those jurisdictions, aside from China, that have introduced CBDCs very early on and without sufficient consultation with the private sector and with the public in general, they haven't really seen sufficient uptake. So you don't necessarily want to be too early an adopter. But secondly, because there is so much work going on in the private sector when it comes to stablecoins and tokenized deposits and things like that. And a lot of those give you the same functional benefits of digital currency without requiring a massive national infrastructure change to support the settlement of those, which is another hugely technical issue for another discussion maybe. But yeah, I think we will see in the, probably in the next 2 years, a lot more happening on the private sector side of things when it comes to digital currency than we will from central banks. Although the UK and the EU have their roadmaps. The EU's is much more detailed for the digital euro and much more clear and things like that. But I think that they're going to be very wary and very careful of introducing something that just turns out to be a massively expensive but poorly used piece of infrastructure without all the kind of private sector and general public engagement that they need to make it successful.
So Jannah, thank you very much indeed for the great hour we spent together. It's been very educational for me and hopefully for our listeners. If anybody wants to get in touch with you at the Digital Pound Foundation, how best can they do that?
Email, so jannah.patchay, digitalfoundation.com. I'm on LinkedIn. The Digital Pound Foundation is on LinkedIn as well. So please, look us up, look up the DPF and follow us. And I think you can also reach out to the DPF via its Twitter and LinkedIn accounts as well, which is possibly a more efficient way than reaching out to me on LinkedIn personally, because we have teams managing the rest of that stuff. But yes, we'd love to hear from anyone who'd like to find out more about our work or, to find out more about ways to get involved with us.
Jannah Patchay, Executive Director of the Digital Pound Foundation. Thank you very much indeed for your time.
Thanks, Hilton. It's been a lot of fun having this conversation with you.
Thank you.